Hi. An old advice for stock analysts is give them price or give them time, but don't give them both. Well, I'm going to break both rules. Why? Two reasons. First, because my US informers that have been most accurate in the past now see things differently than most. But second, my own sleuthing confirms most of the finding. So to cut to the chase, here is what I think is about to happen to the market over the next year and a half. And it's likely to happen in three stages. In the first stage, the market will continue to zoom, as it has been doing for the last little while, just like in 1999, and this means zooming a lot. How high? I'd say from the current level of S&P 5200, it'll get to 6500, maybe close to 7000. And how soon? I'd say this will likely happen before the November elections, maybe well before. Yes. In the second stage, the market will pause, as it did in 2000 after 1999, and meander for a few months. In the third stage, the market will crash in waves, falling to about 1500 or the S&P 500. See, I just broke both rules. I gave you price levels, and I gave you approximate times. Of course, I could be wrong, but I may also not be. Now for the reasons for my outlook. For the first stage, the market will zoom for three reasons. The first reason is the wild recklessness of US Treasury Secretary Janet Yellen. Normally, Treasury obeys the Fed's order to print. But because of the coming presidential election, Janet Yellen rebelled and now prints whatever and how much the hell she wants. She does it with two aims in mind. One, of course, is to flood the market with money so as to help re-elect her boss, President Biden. But the other aim is to burden the US economy with so much debt that if Trump gets in, he would have a total wreck of an economy on his hands. And now here's the second reason for the zoom. Yellen is not the only one printing. Xi Jinping is printing too to save his real estate market. And both money printing, Yellen's and Xi's, serve as a market rocket fuel. And now for the third reason for the market zooming on. Most institutional investors, the big ones, are way underinvested in the market, and so are watching in rising panic the market going up. Because if their portfolio lag, they can be fired. So they chase the market by buying anything and everything. In short, the current market zoom is very likely the beginning of a buying panic. FOMO, fear of missing out. All right, now for the second market stage, the end of the current zoom. Most people say that they never ring a bell at the market top, but that's not entirely true. In major market tops, the Fed does the ringing. But ring how? Like this. When the recession begins to bite, the Fed cuts interest rates to prop up the economy. And when this happens, investors say, oops, the Fed must be seeing what we don't, so we'd better get out of the stock market and sell. So this would be the signal now also. When the Fed finally cuts rates, I would sell everything and go into cash and T-bonds. It'll probably be around S&P 500, 7,000 level. Why this number? It's based on how much Janet is printing, which I can see in the QRA, the quarterly refinancing announcement, where you can see it too. Look it up. This second market stage would see the market flatten, as it did in 2000, after 1999, as the recession began to bite. Oh yes, the recession. In my opinion, it has already started in March or April this year, based on physical sleuthing and on a few indicators which are rarely wrong. Just how bad will the recession get? It'll be worse than bad. It'll be deeper and badder than most investors ever saw, except for all sleuths like me who were in the market in 1982, which was bad enough. Now, how do I know it'll be that bad? First, I talk to people in and around Congress when they are, the best investors in the world, none of whose rewards I can repeat. But there's one indicator I can go into, and so can you, and that's the yield curve. The yield curve is the difference between short-term rates, say 30-year T-bills, and long rates, say 30-year rates. Usually, long rates are higher, because if you lock money for 30 years, you deserve a bonus. But every now and then, before recessions, short rates go higher than long ones. The yield curve is then said to be inverted. So here's the trick that can let you see the future. The longer the yield curve remains inverted, the more fragile the economy becomes. As a result, the the economic downturn that follows is far nastier than recessions who come after a short yield curve inversion, like the one in 1990, 1991. And because the current yield curve has been inverted for a very long time, more than a year and a half, since 2022, the coming recession will almost certainly be very nasty indeed. Based on past yield curve data, if this inversion is going to be as long as the previous longest, it can end between June and September this year, which will make for a super-duper fragile economy. And when such a fractured economy breaks, the market decline following will be correspondingly deep. As I said, 75% to 85% fall, from 7,000 to about 1,500 or so for the S&P. Why this number? Well, in 2000, the market, it was NASDAQ then, fell 90%. And in 08-09, the S&P fell 60%. So I'm taking the average of both long yield curve inversions, market plunges. Now you may ask, can we also try to time the peak based on the yield curve history? We can try. Looking at past market peaks, post-yield curve inversion end, the current market can peak June to September this year, although there's a low probability that the peak can also drag to Q1 2025, that is after the election. But in that case, the following market decline will be truly horrendous. But whether the peak comes in 4 months or in 6, as market imitates waterfall, the economy will crater completely, unemployment will soar to very high teens, and interest rate will plunge probably close to zero. Yes, zero rates. Why do I think so? First, because the economy will be smooshed, so fewer businesses would need to borrow and there'd be far lower demand for money. The yield curve will then, of course, revert. But not only will there be lower demand for money, but also for anything else, which means commodities will fall in price alarmingly fast, which means deflation. Yes, that's a grim scenario indeed. How sure am I of it? Now is the time for 2 more words about Janet Yellen. First, she probably agrees with me about falling interest rates. You see, the latest QRA show her selling more 1-year T-bills than 30-year T-bonds, probably knowing that the deep recession is coming in less than a year, so she could refinance the bills at the lower rates. But the second word comes from my DC informers. Listen carefully. Once the economy craters, there'll be hot pressure on the Fed to print money and inflate, to save the banks and the economy. And it's here my informers have a very different take than Fed watchers. So again, listen up. Normally the Fed tells Treasury what to print and how much to print. And they say, yes, sir, like in 08 or 09 or 2020, but no longer. In their desperation to fight Trump, all over the US, government institutions have allegedly gone rogue. Homeland Security allegedly helps illegal come in to vote. The FBI allegedly organized riots, and Treasury allegedly prints whatever the hell they want. So once the economy craters, if and when Trump is in, Treasury may refuse to print when the time comes. Let me repeat. Treasury then would say to the Fed, we can't hear you. Print, the Fed will say. We can't hear, Treasury may say, just to screw it up for Trump further, which is why this recession may be deeper and nastier than normal, even with a long-lasting inverted yield curve. All because of Treasury rebellion. So say my informers. And of course, there will also be the pre-election riots, now being organized allegedly, as well as the post-election riots, when Trump would try to deport 10 million illegal males who may not live peacefully. In short, when the decline comes, it'll be a dilly, it'll be horrid, but not just yet. So just to sum up my rule breaking, the S&P will likely continue to zoom to 6,500 or 7,000, then flatten. The Fed would cut rates, probably before November, and then the market will flatten and crash in waves to 1,500 or so during 2025, with interest rates going to zero and commodities falling a lot. By that time, probably end of 2025 or maybe Q1 2026, if you have cash, you could buy great value for a song and a half. But remember, the above is just an opinion, and I could very well be wrong, as could be my informers, although we may not be. That's all for now. Please let me know what you think of the above. Subscribe to the channel and retweet to all your friends, subscribers, and followers who they subscribe to. And buy my books, The Sleuth Investor and The Advanced Sleuth Investors, and write reviews about them for Amazon, which I hope will be good ones. I'll see you next time, and meantime, thank you very much for watching.